What if your dream home is built in a neighborhood where the banks quietly refuse to lend? What if your mortgage application is rejected not because of your income or credit score, but because the land beneath your house may one day disappear underwater? And what if the very financial system that enabled millions of Americans to buy homes is now bracing for a climate-driven crisis that could rival the crash of 2008? This is the unsettling reality behind the growing reluctance of banks to provide loans in flood-prone areas. At first glance, it may seem like a conservative risk management strategy. After all, floods are destructive, insurance is expensive, and the costs of rebuilding are astronomical. But underneath these cautious policies lies a deeper fear that climate change and repeated flooding are reshaping the very foundation of the housing market, leaving banks exposed to risks they cannot easily control. To understand why banks are increasingly wary, we need to look at the mechanics of lending itself. A mortgage is essentially a long-term bet. The bank provides money up front, expecting decades of steady repayments in return. The property serves as collateral, a guarantee that if the borrower defaults, the bank can repossess and resell the home. This model depends on a simple assumption that the property will retain its value over time. But what happens when that assumption crumbles? When floods repeatedly damage homes, insurance evaporates, and buyers shy away from risky neighborhoods? Suddenly, the collateral is not reliable. A bank that forecloses on a flooded property may find itself holding an asset worth far less than the loan. The economic risks are amplified by the uncertainty of climate projections. Unlike traditional risks, which can be modeled with historical data, climate-driven flooding does not follow predictable patterns. Areas once considered safe are flooding with increasing frequency. 100-year floods now arrive every decade or every few years. Sea level rise creeps upward, threatening coastal properties once thought immune. This unpredictability makes it nearly impossible for banks to price risk accurately. Faced with such uncertainty, many are choosing the safer option. Avoid lending altogether in the most vulnerable areas. The insurance market, which once provided a buffer, is collapsing under the strain. Private insurers are retreating from coastal states like Florida and Louisiana, citing unsustainable losses from hurricanes and floods. The National Flood Insurance Program, NFIP, long the backstop for homeowners, is deeply in debt and raising premiums to reflect true risk. For many families, flood insurance now costs thousands per year, sometimes rivaling or exceeding their mortgage payments. Without insurance, properties in designated flood zones are virtually unsellable. No buyer will take on that risk, and no lender will finance it. Banks, therefore, see not just a risky loan, but an illiquid asset, a property that cannot be sold easily if repossessed. The parallels with the 2008 housing crash are striking, though the causes differ. Then banks ignored risks, extending credit recklessly on overvalued properties. Now, they are hyper-aware of risks, pulling back credit from vulnerable markets. But the result could be similar: widespread devaluation of properties, concentrated in flood-prone regions, leading to a housing crisis that ripples through the broader economy. Millions of homeowners could find themselves trapped in underwater mortgages, this time quite literally. The psychological factor is also critical. Confidence drives housing markets. Buyers purchase homes when they believe they are safe investments. Lenders issue loans when they believe values will hold. Flooding undermines that confidence. A single catastrophic flood broadcast on national news can stigmatize an entire region. Even homes that escape direct damage may lose value simply because buyers fear the risk. Banks know this. They understand that perception can be just as damaging as physical destruction. A loan in such a market carries risks that go beyond spreadsheets. It carries the weight of fear itself. Another layer is regulatory pressure. Financial regulators around the world are beginning to scrutinize climate-related risks. Central banks and oversight bodies are warning that climate change poses systemic threats to financial stability. In the United States, stress tests for major banks increasingly include climate scenarios. Lenders are being asked to disclose their exposure to flood-prone assets. For banks, this means that ignoring flood risk is no longer just a business decision. It is a regulatory liability. Better to pull back now than face scrutiny or penalties later. The implications of this trend are profound. If banks systematically reduce lending in flood-prone areas, the impact on communities will be devastating. Families may find themselves unable to sell their homes, trapped in declining neighborhoods. Young couples may be unable to buy, shutting them out of homeownership entirely. Local governments reliant on property taxes will see revenues shrink, forcing cuts to schools, infrastructure, and services. Businesses dependent on stable communities, restaurants, contractors, realtors will suffer. What begins as a banking decision ripples outward, eroding the very fabric of cities and towns. For some, the response will be to fight harder for protection. Communities may lobby for seawalls, levees, and drainage systems, arguing that infrastructure will reduce risk and restore lending confidence. But such projects are enormously expensive, and in many cases, they only buy time. Rising seas and intensifying storms will eventually overwhelm even the most sophisticated defenses. Banks know this, and they are unlikely to be reassured by promises of temporary fixes. Others will turn to government for relief. Calls for federal programs to backstop lending in flood-prone areas are already emerging. Just as the NFIP was created when private insurers withdrew, new initiatives may be proposed to keep mortgages flowing where banks fear to tread. But these programs would shift risk from banks to taxpayers, raising questions of fairness. Should public funds subsidize lending in areas that are knowingly vulnerable? Should taxpayers in safer regions bear the cost of keeping coastal or riverfront housing markets afloat? These debates are likely to intensify as floods grow more frequent. The human cost of bank retreat cannot be overstated. Imagine a family that has lived in the same coastal town for generations. Their home is modest but deeply meaningful. They want to pass it on to their children. But when they apply for a loan to renovate or refinance, they are rejected. When they try to sell, buyers cannot secure financing. Slowly, their property value collapses. Their wealth evaporates, not because they made poor financial decisions, but because the geography of risk shifted beneath them. This is not just an economic story. It is a story of dignity, heritage, and belonging. Globally, the trend is even more alarming. In countries like Bangladesh, where millions live in low-lying areas, or in Pacific Island nations, entire populations face the prospect of being deemed unbankable. International lenders may shy away from financing development, leaving vulnerable nations without the capital needed to adapt. The very communities most in need of investment may be cut off from it entirely. This dynamic risks deepening inequality on a global scale, creating financial deserts in the very regions most affected by climate change. For banks, the calculus is cold but rational. Their mission is not to preserve communities or protect culture. It is to safeguard capital and generate profit. Flood risk undermines both. Yet the consequences of their withdrawal will be anything but rational for the people left behind. This tension between financial prudence and human survival will define the coming decades. The choices ahead are stark. Banks can continue retreating, leaving flood-prone areas to fend for themselves. Governments can intervene, propping up lending with taxpayer funds. Or society can confront the deeper issue, the need to adapt, relocate, and fundamentally rethink where and how we live. Each option carries costs, and none are easy. But ignoring the problem only ensures that the eventual reckoning will be harsher. This is why banks are afraid to lend in flood-prone areas. It is not simply about water damage or insurance costs. It is about the collapse of confidence, the erosion of collateral, and the inevitability of loss in a changing climate. They see what many homeowners cannot bear to admit, that some places may no longer be safe bets, no matter how much history or hope is tied to them. For homeowners, policymakers, and communities, the question is unavoidable. If banks are pulling back, what will you do? Will you rebuild and fight to hold on to the past, or will you accept the painful reality and move toward higher ground? The future of flooded regions depends not only on rising seas, but on the decisions we make today, about risk, about resilience, and about where we choose to place our faith. Banks have always been in the business of measuring risk. They lend money when they believe the odds of repayment are strong, and they turn away when those odds begin to weaken. For most of modern history, the risks tied to real estate were seen as stable. A house was considered one of the safest forms of collateral. an asset likely to appreciate over time. But in the age of climate change, that assumption is crumbling, and nowhere is it clearer than in flood-prone regions. The reluctance of banks to lend in these areas is not an abstract fear. It is a reaction to a growing body of evidence showing that floods are becoming more frequent, more destructive, and more costly. Rising seas, stronger storms, and heavier rainfall are colliding with outdated infrastructure and reckless development, creating a perfect storm of financial vulnerability. Banks, looking decades ahead, see themselves trapped between borrowers who may default and collateral that may literally sink beneath the water. The economics of this dilemma begin with property values. A home is more than shelter, it is an asset. Its value underpins the mortgage system, determines tax revenues for cities, and fuels generational wealth for families. When floods strike repeatedly, those values fall. Buyers hesitate, insurers withdraw, and demand dries up. For a bank, this means that the collateral securing a loan may no longer cover the balance owed. If the homeowner defaults, the bank is left with a devalued property that cannot be resold at a profit. Insurance was supposed to shield against this problem, yet insurers are themselves retreating from high-risk regions. In the US, private insurance companies have pulled back from coastal states like Florida, while the National Flood Insurance Program is billions in debt. Premiums are soaring to reflect true risk, making homes unaffordable for many buyers. No insurance means no mortgage, because lenders will not finance an uninsured property. Even with insurance, skyrocketing costs reduce demand, further eroding values. Banks are caught in the middle of this shrinking safety net. The unpredictability of climate-driven floods makes the situation even worse. Financial models depend on historical data, but past patterns no longer apply. A 100-year flood may now occur every decade. Neighborhoods once considered safe are suddenly at risk. For banks, this uncertainty is almost impossible to price. The easiest response is the most cautious. Stop lending in vulnerable areas altogether. The ripple effects are immense. Families find themselves trapped in homes they cannot sell, unable to refinance or secure equity loans. Local governments watch property tax revenues decline as values collapse, undermining schools, infrastructure, and public services. Entire communities begin to hollow out, creating pockets of abandonment within cities. And as these neighborhoods falter, their struggles spill over into regional and even national economies. Globally, the picture is even more stark. In countries with fewer resources, the withdrawal of banks from flood-prone areas risks leaving entire populations without access to credit. Development slows, adaptation becomes harder, and inequality deepens. For small island nations or low-lying megacities, being labelled too risky to finance could mean economic isolation at precisely the moment when they need investment most. The core issue is this: banks fear lending in flooded regions because the traditional pillars of housing finance, stable property values, reliable insurance, predictable risks, are collapsing under climate pressure. What was once one of the safest bets in finance is becoming one of the riskiest. Until adaptation measures catch up, and until there is a clearer framework for sharing risk between lenders, governments, and communities, banks will continue to pull back. This creates a painful paradox. The communities most in need of investment to adapt to floods are the very ones being cut off from credit. Without loans, they cannot rebuild stronger. Without rebuilding, they remain vulnerable. Without value, they cannot borrow. The cycle feeds itself, leaving families, cities, and nations caught between water and financial walls closing in. The question is no longer whether banks are justified in their fear. They are. But what society will do about it? Will we create policies that spread risk more fairly? Will governments step in with new programs to keep credit flowing? Or will we allow market forces to push entire regions toward decline? For families in flood zones, this is not an abstract debate. It is the difference between holding on to the dream of homeownership and watching it slip away with each rising tide. For banks, it is the choice between preserving capital and participating in the survival of communities. And for all of us, it is a glimpse of the future we face in a world where water no longer respects the boundaries of finance, but floods them. When banks hesitate to lend in flood-prone areas, they are not simply protecting themselves. They are signaling a deeper systemic shift. It is a warning that the assumptions underpinning modern housing finance no longer hold. The house, once considered the bedrock of family wealth and community stability, is being reclassified as a fragile and risky asset in certain regions. And while homeowners may view this as unfair or overly cautious, the financial sector sees it as unavoidable. To understand why banks are pulling back, it helps to trace how risk ripples outward from individual properties to the larger economy. Imagine a coastal neighborhood where houses have flooded multiple times in a decade. Buyers hesitate to enter the market, insurance premiums skyrocket, and sellers cannot find fair offers. For a bank, issuing new mortgages in such a market is like extending credit to a collapsing business. Even if the borrower is reliable, the underlying asset is deteriorating. No prudent lender wants to hold collateral that is both devalued and potentially unmarketable. But the concern extends beyond isolated neighborhoods. Mortgage-backed securities, bundles of home loans sold to investors, are a cornerstone of global finance. If too many loans from flood-prone areas default, the ripple effect could reach pension funds, insurance portfolios, and investment banks worldwide. Regulators remember the devastation of 2008, when risky subprime loans nearly crashed the global economy. This time, the risk is not reckless lending, but climate instability, and the fear is that flooded futures could trigger a similar chain reaction. For banks, climate risk is not just theoretical. Credit rating agencies have begun incorporating climate vulnerability into their assessments. Investors demand transparency about flood exposure. Central banks warn that climate change poses systemic financial threats. In this environment, ignoring flood risk is not just risky, it borders on negligence. That is why banks are proactively scaling back before the losses pile up. Yet this prudence carries a human cost. Homeowners who once relied on easy access to mortgages now face shrinking options. Refinancing becomes difficult, home equity loans disappear, and selling is nearly impossible without a willing lender for the buyer. Families who plan to use their homes as retirement investments watch their wealth erode. Communities that depend on property taxes see revenues collapse, forcing cuts to schools and public services. What begins as a financial calculation in corporate boardrooms translates into real hardship on flooded streets. The divide between those who can adapt and those who cannot grows wider. Wealthy homeowners may relocate to safer areas, absorbing financial losses in exchange for long-term security. Developers with capital may pivot to higher ground, investing in projects with lower risk profiles. But poorer families, already living on the margins, find themselves trapped. They cannot afford relocation, cannot sell, and cannot secure loans to rebuild. They become climate prisoners in homes that are both unsafe and unsellable. Banks, by withdrawing, may avoid losses, but the burden falls squarely on the shoulders of those least equipped to bear it. There is also a moral dimension. Should financial institutions, with their vast resources, play a role in helping vulnerable communities adapt? Or is their sole responsibility to shareholders, protecting capital at all costs? This debate mirrors larger societal questions about responsibility in the era of climate change. Do we leave people to fend for themselves in risky areas? Or do we find collective solutions that balance financial prudence with human survival? Some propose government intervention as the answer. Programs could be designed to share risk between public and private sectors, ensuring that credit continues to flow while insulating banks from catastrophic losses. The National Flood Insurance Program was one such attempt, though its mounting debt highlights the challenge of sustaining such systems. Others suggest climate resilience bonds, community-based insurance pools, or new financial instruments tied to adaptation projects. These ideas reflect an urgent reality. The private market alone may not provide the safety net that millions of families need. But even with innovative solutions, there is a hard truth. Some areas may no longer be viable for long-term habitation. Banks are not wrong to fear lending in places where sea level rise and repeated flooding make collapse inevitable. Managed retreat, relocating people and resources to safer ground, will become part of the solution. The question is whether it happens chaotically, driven by financial abandonment and disaster, or strategically, guided by policy and foresight. This brings us to the broader societal challenge. We must rethink the relationship between finance and geography. In the 20th century, the expansion of lending fueled suburban growth, coastal development, and the dream of homeownership for millions. In the 21st century, climate change demands a recalibration. Not every piece of land is a safe investment. Not every neighborhood can be defended indefinitely. Recognizing these limits is painful, but denial will only make the reckoning harsher. For homeowners, awareness is critical. Understanding why banks hesitate is the first step toward making informed decisions. Buying in a flood-prone area may seem appealing now with low prices and potential bargains, but the hidden costs are immense: soaring insurance, limited financing, and declining resale value. For policymakers, the task is to provide clear information and fair options. Families should not discover too late that their investments are unsustainable. For banks, transparency matters. Silent withdrawals erode trust. Honest communication about risk allows communities to prepare, even if the message is unwelcome. Globally, the pattern is unmistakable. From Florida to Bangladesh, from Venice to Jakarta, flood risk is reshaping financial landscapes. Lenders are adjusting, insurers are retreating, and investors are recalibrating portfolios. The question is not whether these shifts will happen, but how quickly, and who will be left behind in the process. The story of banks retreating from flooded futures is in many ways a warning shot. It tells us that the age of climate denial in finance is ending. Numbers do not lie, and balance sheets cannot ignore rising seas. The challenge for society is to ensure that this rational financial shift does not translate into irrational human suffering. Adaptation must be shared, not abandoned. Responsibility must be collective, not deferred. And this is where you, the viewer, come in. These issues are not abstract. They affect communities across the United States and the world. They affect whether your home retains value, whether your neighborhood thrives, and whether your children inherit stability or crisis. That is why we bring you these stories at Crisis Lens, to illuminate the hidden forces shaping our future and to spark conversations that can lead to action. If you found this exploration valuable, don't stop here. Subscribe to Crisis Lens to stay updated on the real risks facing our homes, cities, and economies. Like and share this video to spread awareness, because the more people understand the stakes, the better prepared we will be. And watch the full series to see how climate change is reshaping not just finance, but every aspect of our daily lives. The floods are rising, and the banks are already responding. The question is, will we respond too? Or will we wait until the water and the markets decide our future for us?